Welcome to the deep dive. You probably spent the last week seeing headlines everywhere about, well, government shutdowns, potential sanctions, trade talks getting tense.
Yeah.
The Washington news cycle feels like a total mess. And yet, somehow, the U.S. stock market just hit all-time record highs.
It sounds completely backwards, doesn't it? That's really our mission today. To dive into the sources, we've got a market outlook report here. It covers October 20th through the 27th.
Right. So let's start with the economic data that really kicked off this optimism. Cooler inflation.
Yeah, that was the biggest catalyst of the week, hands down. The Consumer Price Index report, the CPI. Well, the main number, the headline CPI, came in pretty cool at 0.3%. That was just a bit below the 0.4% from before, and also what analysts expected.
Okay.
But the real story, the one everyone watched, was core CPI.
And just quickly, for anyone not tracking the Fed daily, core CPI that strips out the jumpy stuff like food and energy, right?
Yeah.
Gives a cleaner look at underlying price trends.
Exactly. It shows the real underlying pressure. And what we saw there, core CPI dropped to just 0.2%.
Oh, wow.
Analysts were looking for 0.3%. Now, that 0.1% difference, it might sound tiny, but it was the first real slowdown in core inflation we've seen in 4 months. That's why, investors basically felt like popping the champagne.
Okay, so this cooler data point almost immediately locked in the market's thinking on what the Federal Reserve does next with interest rates.
Oh, absolutely. The certainty now it's almost total. If you look at the Fed funds futures market, investors are pricing in a massive, 98% probability the Fed cuts rates by 25 basis points in October.
98%.
Yeah. And looking further out to December, there's a 93% probability for another 25-point cut.
Okay, that leads us right into the next bit, the headwinds, the things the market seems to be consciously ignoring right now.
Yeah.
Because while core CPI was great news, these geopolitical risks are already, throwing gasoline on the headline inflation picture, literally.
This is exactly where that optimism feels a bit fragile. We saw oil prices jump, a huge 8.0% just over the past week.
8%.
Yeah, that's a massive move for a single week. And it was a direct response to President Trump announcing sanctions on 2 of Russia's biggest oil companies.
Okay, hold on. So we just celebrated cooler inflation.
Right.
And now oil spikes 8%. Yeah, how does that mess with the economic picture we were just painting?
Well, it immediately puts pressure back on those headline inflation numbers. If oil stays up here, it feeds right into gas prices, pushes headline inflation up, and could start cutting into consumer spending power. Now, the only maybe silver lining is that gas prices had been pretty low recently, lowest since last December, I think.
Okay.
So maybe the initial shock to people's wallets gets absorbed a little, but still, it's a direct challenge to that nice cooling inflation story.
And then there's the other, elephant in the room. The market's just shrugging off. The government shut down. It's now, 27 days old?
27 days, second longest in U.S. history.
Wow. And at first, it felt kind of abstract, maybe, but the pain points are getting very real now.
Oh, they are. They're worsening almost by the day. We're moving past just political squabbles into real economic effects. Federal workers who are furloughed, they missed their first paycheck last week.
Right.
And more critically, maybe food stamp programs. They're set to start running out of money in several states by November 1st.
November 1st. That's soon.
Very soon. And look at the disruption. We're heading into the big holiday travel season. And suddenly there are reports of these huge lines at airports because of government worker shortages, TSA staff, air traffic controllers.
It's not just inconvenient. That directly hits consumer confidence, right? Which is 70% of the whole economy.
Exactly.
What kind of GDP hit are we talking about if this drags into November? Is there an estimate?
The risk is definitely significant, and that's precisely why everyone's laser focused on Tuesday's Consumer Confidence Index from the Conference Board. That release is going to give us the first real clue about how consumers are actually reacting to all this political mess right as they're making their holiday spending plans. If confidence tanks, well, then the shutdown starts hitting the market where it hurts.
Okay, and speaking of the Fed, they're signaling rate cuts maybe? But on the other hand, they're still tightening somewhere else, aren't they? Let's talk quantitative tightening, QT.
Yes.
Because Fed Chair Powell's comments on QT at the upcoming Wednesday meeting, that's going to be watched incredibly closely.
It absolutely is. QT is just the Fed shrinking its huge balance sheet, right? Taking liquidity out of the system. They've said over and over they'll stop this once bank reserves. The cash banks keep at the Fed get down to what they call ample levels.
Ample. Okay, that sounds like the $1 million or $1 trillion word here. What does ample actually mean?
It's basically the minimum amount of liquidity the financial system needs so things don't start seizing up, like the oil in your car engine, maybe?
Yeah.
How low can those bank reserves go before the system starts sputtering? Well, reserves actually dipped below $3 trillion earlier this month. As of October 22nd, they were sitting at $2.9 trillion.
Okay, $2.9 trillion. Now, here's where it gets a bit technical, but it feels important. Defining that minimum, that ample level.
Right. So Governor Christopher Waller, he's a key Fed official. He'd previously kind of estimated that floor at around $2.7 trillion. But his recent comments suggest he might think reserves are already low enough. So we're kind of in this financial guessing game watching this $200 billion gap between the current $2.9 trillion and that old $2.7 trillion estimate.
Okay, let's completely switch gears now. Let's talk about the engine that's actually powering this huge rally, the thing that's somehow overpowering all those risks we just discussed. U.S. markets and the sheer momentum from earnings.
Yeah.
Despite every single one of those serious headwinds, all the U.S. stock segments hit record highs during this period.
Momentum was just relentless. And broad, too. Host speaker, large cap stocks up 2.1%. The NASDAQ, heavy on tech, surged 2.8%.
Yeah.
And growth stocks, the innovation engine, they climbed 2.6%. This wasn't just a little blip. It was a sustained, wide-ranging rally. And it was really driven by the corporate numbers coming in.
And the Q3 earnings season has been, pretty spectacular, hasn't it? Is this just cost-cutting, or is there real demand fueling this? Is there a catch?
The data points to real strength. So reported sales growth for the S&P 500 in Q3, a solid 8.3%.
Right.
But earnings growth, even stronger, up 13.2%. And what's really telling is the surprise factor. Earnings are beating what analysts expected by an average of 6.1%.
6% beat on average.
Yeah. Analysts keep underestimating how profitable and, frankly, how resilient corporate America is right now.
Okay, here's the thing that really jumped out at me, the aha moment, maybe.
Yeah.
It proves this rally isn't just, the AI hyped or those few big tech stocks. Look at GM, General Motors.
Right.
They were up almost 20% for the week
Right.
after crushing estimates. GM.
Really?
Yes, GM is actually a perfect example. It shows the sort of industrial heart of the economy is also running really hot. They beat revenue estimates by, 7.6%, and earnings estimates by a massive 23.2%.
23% beat on earnings. Wow.
When you see the big industrial giants delivering numbers like that, the underlying economic engine is pretty robust. It's not just concentrated in a few, high-flying tech names.
That momentum gets a huge test this week, doesn't it? We're about to get Q3 results from the absolute biggest players, Microsoft, Amazon, Apple, Alphabet, Meta. If those names disappoint, this record run could definitely pause. Oh, absolutely. That's a major hurdle. And the other huge macro event just hanging over everything is the China trade situation. Investors got really encouraged by the expected meeting between President Trump and President Xi on Thursday.
This feels like it could go one of two ways, completely. Like a coin flip.
Pretty much. If they reach some kind of resolution or even just a compromise on the U.S. China trade stuff, that would likely spark another big rally, probably quite aggressive.
Okay.
But if that meeting produces nothing concrete, or worse, if it breaks down acrimoniously, then yeah, you probably brace for a sharp sell-off. People are really holding their breath for that one.
Right. Let's move into our final segment. Let's look globally. How did the rest of the world do compared to the U.S., and how are investors maybe shifting their portfolios around?
Yeah, globally, the picture was a bit more mixed, but still mostly positive outside the U.S. Developed market stocks were actually down slightly, about 0.1%, but emerging markets were up pretty strong, plus 1.4%. So it shows the appetite for risk is coming back globally, though, they still significantly underperformed those huge gains we saw here in the States.
But there were a couple of massive standouts globally, weren't there?
Yeah.
And they seem totally tied to politics, either certainty or massive upheaval.
Yeah.
Japan first.
Yeah.
Hit a record high, crossed 50,000 today for the first time ever.
Japan was on fire, up 2.7% just for the week, and that's part of this incredible 12.4% surge just in October alone.
Wow.
It's really a continued positive reaction to their newly elected prime minister. Investors seem to be rewarding that political certainty, the expectation that reforms will continue. It just shows, when political leadership is seen as market-friendly and decisive, that translates almost instantly into confidence.
Argentina. When you see a stock market jump 27.7% in 1 week,
yeah,
something truly seismic just happened.
That gain was just phenomenal. It was driven by two things happening at once. First, The U.S. promised support for Argentina's currency, which is like a financial lifeline.
Okay.
And second, you had these decisive midterm election victories for the Libertarian president, Javier Milei, in key districts. That really cemented his mandate for pretty radical economic reform.
Oh, okay.
So you combine that radical political shift with external financial backing. Boom. The market just went into overdrive.
So let's flip to the defensive side of things. Gold. It had a really significant pullback, down 8.2% this week, which is interesting because it's still up, what, over 50% for the year?
Yeah, way up year to date.
What does that pullback tell us about risk sentiment right now?
It's almost the perfect signal that the market is firmly in risk-on mode, at least for now. You had the strong earnings we talked about,
Right.
the weaker CPI number, and this renewed hope for maybe a trade deal. All those things together just lessen the immediate need for gold as a hedge. Gold is kind of the ultimate fear barometer, right? And when fear pulls back, even temporarily, investors tend to take some profits off the table in gold and move that cash back into things like stocks.
Okay, and finally, bonds. You mentioned they had a remarkably quiet week.
Yeah, very quiet. The yield on the main benchmark, the 10-year Treasury, it only moved up 1.1 basis points. That's basically flat in market terms. It closed just under 4%.
Why so stable after that big CPI news?
It's actually pretty predictable. The market had really already priced in that consensus view for Fed rate cuts the week before. So when the CPI data came out and basically just confirmed what everyone already expected, there wasn't a big reason for a sudden rush to buy or sell bonds. That move was already kind of baked in.
Okay, so if we try and pull all this together for you, the listener, what's the key takeaway here? What's the bottom line?
I think the main message is that right now, the market is laser focused on rewarding hard data. Verifiable things, corporate performance, the inflation numbers. That good news has basically acted like a Teflon shield against all those political risks. The shutdown here, the sanctions abroad, at least for this moment, it suggests there's this really deep-seated optimism about the fundamental health of the U.S. economy.